Hello again. Welcome to another episode of the Uranium Market Minute. Today is Friday, June 13th, and this is episode number 210. My name is Justin Huhn. I'm your host. I'm the founder and publisher of the Uranium Insider Investing Newsletter, the only investing newsletter focused solely on uranium and that publishes on a regular monthly basis. As always, nothing that you see or hear in this podcast is intended to be investing advice. I am not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing and always take responsibility for your own choices. Okay, really wonderful to be back with you again today. It has been some time since I published an episode of the Uranium Market Minute podcast. That long period between episodes is about to change. I'm going to be publishing these on a much more frequent basis. So hopefully that is helpful to you in your investing journey in uranium or otherwise. So much has happened since October. I hope that you and yours are well. A lot of developments in the uranium space, a lot of developments in the nuclear space. In today's episode, I'm going to be focusing on what we see as a looming supply crisis for uranium. The demand story for the nuclear industry globally has been so de-risked from the developments over the past, let's say, 3 to 5 years that the real thesis, if we go back late 2010s, really was all about the stability and the growth rate of demand. So we had the commodity trading well below the price of production for multiple years. We had large mines like Langer Heinrich, like McArthur River coming offline. A lot of supply had been idled. Those mines came offline because the price was so low. Yet the thesis was based around, okay, this is a stable industry. Demand is there. It is slightly growing. The price has to rise, at least getting up to that production cost level. So when we were trading at $18 a pound spot, 25 term, we knew it had to go into the 40s term, 30s spot, and possibly even higher going back 2017, 18. Since then, the demand story has become so robust with the growth of electricity demand from AI and data centers that a lot of the global reactor fleet has been largely de-risked, and we've had a few more premature shutdowns in the last year or so, a couple in Belgium, one in Taiwan, which they might be reversing. I'll get into this a little bit deeper when we get into it. But what we're going to focus on today now is the robustness of the demand is there, the demand story. The supply is really what is going to be largely problematic and is going to be the main driver of the price response for the commodity in the years to come. So we're really going to dive into that. I'm going to share with you the results of our internal supply and demand modeling. This has previously been only shared with Uranium Insider members. And Uranium Insider members, of course, will have much greater access to the granular data that results in the images that you are going to see. If you're new to this podcast, if you're new to the uranium thesis, to the nuclear growth story, you're going to want to shore up your knowledge on that. Part of that is listening to podcasts like this, doing your own research. We also have a white paper, The Case for Uranium. It's free. You can download it in the link below. A lot of what I'm going to talk about today is included in this white paper that will also give you a much more broad 30,000 foot view of exactly what is going to be driving this thesis in these sectors for the years to come. So download that below. It's absolutely free. The link is in the description. There are so many directions I could take this because so much has happened since my last episode. But like I said, I'm going to be focusing on the supply story and the likely situations that are going to pan out in the coming years that is going to affect supply availability and therefore price. So on that note, let's just dive right into it. The graphic on this slide is a representation of our reference case. This is to say that this is the supply and demand model case that we feel is most accurate and most likely to pan out. So that is to say, we have to have a certain amount of assumptions in this modeling, right? So you can take this year, the next couple of years, 2, 3, 4 years with very high accuracy in terms of both demand and supply. We know what's operating in the world. We know what is under construction is likely to hit the grid. We know with a pretty large amount of confidence what is likely to be life extended. Largely, those are reactors in the United States and other countries that are seeing very fast rates of growth in terms of electricity demand. On the supply side, we know what's coming out of the ground this year. We know what brownfield projects are undergoing restart. We know what greenfield projects have hit the ground and may or may not be producing in the next handful of years. Once you go out into the 2030s, let's say, and especially like 2032 or 3 or beyond, that's where it gets a little bit tricky. So we have a lot of very, very crucial, large greenfield supply projects, uranium mines, that have not yet had a shovel hit the ground. And what's interesting about this is that the industry believes that these projects will come online on time, on budget, as the companies state that they will in their own feasibility studies, or in some cases, even their final investment decisions, where they have an expected capex, they have expected time frame, and an expected annual production and life of mine. And so that's what the investors see. And that's also what the utilities, the nuclear utilities see. So they see, okay, Arrow is going to be producing in 2030. Phoenix is going to be producing in 2028. DASA is about to start producing. We'll have secondary supply. The war in Ukraine is going to end, and all of a sudden uranium will come coming through the faucet, which is absolutely insane. Russia is net short uranium. They're net buyers, even of UF6. They need uranium. They have a lot of enrichment. They need as much uranium as they can get. In fact, they might even be short this year in their deliverables because of that shortage of uranium feedstock. But I digress. According to our internal model, the cumulative supply deficit for the next 10 years is greater than 400 million pounds. And there's a decent amount of assumptions that we're going to line out for you in the next slides of what is resulting in these numbers. Why is there such a deficit? What are we assuming that ends up putting out these types of numbers? And we'll get into that in just a minute. As you can see from this graphic, we have a very robust growth rate for the industry. We're seeing, like I said, we're seeing life extensions almost entirely across the board with very few exceptions. We are possibly even going to see some restarts of reactors, especially here in the United States. SMR demand, which is the dark gray portion at the top of this graphic, that is actually has already started. We've seen OPG come into the market in 2023 for uranium for their BWRX 300 SMR build in Ontario, Canada. So while that shows in our demand, zero demand from SMRs until 2029, we know that is highly, highly conservative. That demand, of course, grows significantly going out to 2035 and beyond. But SMR projects, when the shovel actually hits the ground to get these things built, uranium demand comes into the market not much longer after that first construction, and that is typical, actually. You want to make sure you're going to have the fuel on hand for these projects. The bright blue segment of the vertical bars in this graphic, of course, is greenfield supply, and you can see this is really the thematic of this topic of this podcast. Greenfield supply is absolutely necessary to fill that gap. There just isn't a sufficient secondary supply or inventory buffer in this industry any longer. This has existed for decades and decades and decades, and there literally is not inventory hanging over the market as it has been for the last 50 years. It just isn't there. The deficit that we forecast, and that pretty much everyone is forecasting at this point, must be filled by new supply coming out of the ground, largely from projects that have not even put a shovel in the ground yet. So the likelihood of these projects coming on time, on budget to produce yellowcake in a can is largely going to dictate where the price moves in the future. So let's dive into the next slides. The majority of nuclear utilities globally are uncovered for uranium beginning in 2031. So the coverage rates start out very, very high going out the next year or two, and that's always the case in this industry. This industry lives in the future. The fuel cycle takes a minimum at this point of 24 months to go from uranium to conversion, to enrichment, to deconversion, to fuel fabrication, and then delivery to a nuclear reactor site. That takes at least 2 years. It used to be, 18 to 24 months. Now we're looking at 24 months plus, 24 to 30 months most likely for the whole fuel cycle. And for that reason, nuclear utilities and fuel buyers, they will always have at least the next core load, and then usually about 2 to 3 years of inventory throughout the fuel cycle. So when you see coverage rates for 2026 and 7 are 80, 90, 100%, that's always the case for the forward year or two. When you go out a few years, and in this particular example, going out 5 years, 2031, the majority, that's greater than 50%. So that's like 70% of US utilities, about 50%, 55% of EU utilities. And of course, we know the Eastern Asia and the Japanese, the Korean utilities are less covered than both Europe and Asia, to speak generally. So huge demand. And why is that important? Well, according to our reference case model, you see these very, very large greenfield projects that are coming online in the early to mid 2030s, hypothetically speaking. Those are necessary to fulfill that supply gap, and that also is the time frame where we have an enormous amount of buying that still has to happen on behalf of utilities. And the big question is, who has material for sale in sufficient volume for those uncovered years? And the answer is basically nobody. So the existing producers have some availability of pounds when we go out into the 2030s. Cameco, Orano, BHP, Uranium One, some of the traders, and then getting into the developing companies like NextGen, like Denison, like Global Atomic, and there are a few others, right? These projects are absolutely paramount. But the important point here is that there's insufficient supply for this time period where there's an absolutely gigantic amount of demand on behalf of utilities that is yet to be covered. So when that demand comes into the market and when it finds that there is insufficient supply, we're going to see a large price response to the upside. So what are some assumptions for our reference case? The long-term uranium price continues to rise and sustains above $100 a pound. Now, the long-term uranium price right now is $80 a pound, as reported by UxC. We assume that the price will rise sufficient to incentivize some of these larger, lower-cost projects. So included in this reference case model are Tumas, Etango. These are larger, 3+ million pound per year open pit, lower grade deposits in Namibia. Both of these projects, Bannerman and Deep Yellow, have projected are being delayed in their final investment decision. Why? Because the price range that the market is trading at right now is insufficient. That's A. And B, there's insufficient demand on behalf of utilities at a price that will justify those projects. And that is the case, absolutely. You're going to see a slide in just a minute here showing the long-term contracted volumes in the previous cycle and what's been done so far during this cycle. We're just not going to see high volumes of contracting until we're at a higher price. Why? Because the pounds available here at $71 spot, $80 term are few and far between. And there's only a couple of sellers that are willing to sell pounds at that price. Higher prices are going to be needed even for the likes of Cameco or Urano to contract at higher volumes. They're not going to give these pounds away. So we assume that the price is going to rise. And I'll show you a graphic in just a minute of what happens if the price doesn't rise. And that will obviously aid in your conviction that the price has to rise. It absolutely has to. In order for even this concerning looking deficit graphic here in our reference case, this is at $100 a pound plus. Let's continue. We assume that Kazakhstan ramps production to around 70 million pounds a year. They produced a little over 60 million last year. That'll bump up a couple million pounds this year, but their big project, Budenovskoye 6 and 7, has been delayed significantly. We expect that will eventually produce at full production, but we don't expect that Kazatomprom will hit that nameplate 100% subsoil across their projects. And there's plenty of reasons why. That's not just because we have a bullish bias. It's because we're looking at the data. And the data say that multiple of their joint venture projects, especially with their Western JVs, are stable, if not declining in their production. They're not rising anywhere close to the tune where we see them projecting 100% subsoil 80 million pounds per year. Either way, we expect they will be able to ramp, and that is in our model. We expect that most DFS, definitive feasibility study stage projects, are built. So any of these projects like Etango, like Tumas, like DASA, Phoenix, Arrow, all of these are DFS stage and beyond, even into early stage of development, or in the case of Global Atomic, pretty advanced stage of development. We expect that they are built. So price rises to incentivize those lower cost projects, and they do get built. That obviously includes ramp ups in ISR projects in the United States. That includes, and we'll get to this in just a minute, but MacArthur ramping, which they have not announced yet, but it is possible. It is in our model. We assume that 0 reactors restart in Germany. Of course, we know that might not be the case. Just today, there were news stories about a German utility that is lobbying for a restart. So it is possible. We're not holding our breath, but we're modeling for 0 of these reactors to be restarted. Spain has 8 reactors operating. All of them are set to shut down in the next 10 years. In our model, we have 0 extensions of the Spanish fleet, but we do know that it is possible, and it's actually likely that some of those reactors will be extended. Of course, Spain had a countrywide blackout about a month ago that really put a spotlight on the frailty of the large amount of renewables that they have in their grid and the importance of stable baseload power. We also model for no new nuclear capacity in the United States. Now, there already have been some upgrades. We know that the Palisades is getting restarted, so that is included in our model. But as far as new builds, we are modeling for zero. The demand for uranium coming from new builds in the United States might be 2 years from now, it might be 3 years from now, but it's absolutely this cycle. And we saw a big story out of the Financial Times today that Westinghouse is basically getting their ducks in a row, connecting with developers and utilities to potentially meet the executive order demands that were signed by President Trump 2.5 weeks ago to have 10 reactors, 10 new large reactors, have construction started on those reactors by 2030. So if we see an announcement of that, we see shovels hit the ground in the next 2 or 3 years, we're going to see uranium demand in the market for those new builds. We are modeling for zero of that. Okay, so no new capacity. Restarted capacity from Palisades? Absolutely. Restarted capacity from 3 Mile Island starting in 2028? Yes, that is in the model. What about Dwayne Arnold? Not there. What about a restart of the construction of VC Summer? Not there. New SMRs? We have an early construction permit right now from the Tennessee Valley Authority to build the first GE Hitachi BWRX 300 at the Clinch River site in Tennessee. That is not in our model. Of course, they haven't started construction, but they are seeking an NRC permit to have an early construction start for that particular project. My point is there's significant potential demand for uranium in the next 2 or 3 or 4 years that is absolutely going to affect the overall demand story and the tightness of supply. And those right tail elements are not in our model. Lastly, our model assumes a 3.1% compound annual growth rate between now and 2035. And that is based on what we know, okay? That is based on reactors under construction right now that are going to hit the grid during that time frame. Reactors currently operating, the life extensions that are going to be granted across the board in the US, most likely, even though not in our model, would be an extension of Diablo Canyon. The NRC has approved the safety of those reactors to be extended beyond 2029 and 2030 when they're set to shut down right now. So what are we going to see from that? Will we see Diablo Canyon extended? When PG&E got the green light for the extension from 24-25 to 29-30, they came right into the market with a big fat RFP, and that was one of the key elements that started to kick off the market moving in 2023. That was for a 5-year extension, and they're on the brink of getting a 20-year extension. So that one nuclear power plant, 2 reactors being extended for 20 years is going to disrupt the long-term contracting market. Period, full stop. So we assume a compound annual growth rate of 3.1%. The only elements that we plug into this model on demand are Chinese and a couple of Indian reactors starting in 2033. Everything else is basically known. What's operating, what's going to be extended or not, what is under construction is going to hit the grid. So the only reason we plug into China is because China is building reactors in 5 or 6 years. So there are reactors 1,000% that have not started construction in China yet that will be operational before 2035. That's why we have a few plugs in there for China and India. Besides that, the rest of the demand story is largely known. So I talked about some of these right tail events, right tail being demand supportive, left tail being the opposite. The most probable supply demand shocks are right tail. So let's get into what could happen in the next few years that could affect things to the upside or the downside. Let's start with left tail, which are certainly possible, but let's talk through them. Nuclear accident, always possible. And everybody, of course, thinks back to the most recent large nuclear accident, Fukushima Daiichi, March 2011. That, of course, was terrible for sentiment. That event in and of itself caused the market to contract. The big element of that was that the Japanese shut down their entire fleet over the course of about 12 months. And then multiple other countries, and most notably Germany, engaged in phase out policies where if they had currently operating nuclear reactors, their policy was these would be shut down by X years. So by Germany, it was 2024. And here we are, right? So a nuclear accident would be bad for multiple reasons, but of course, for uranium demand and for sentiment in the sector, it would be bad to begin with. How the operators of the world react to such an event would really dictate whether or not that poor sentiment and action in the market would sustain. So if we had a significant reduction in the current construction pace in China, if we had a bunch of reactors close in response to that, that would be bearish. Okay, I'm not going to gloss over all of this. An accident would be bearish, always possible. That's part of what makes this sector so volatile and so potentially exciting is there is this thing kind of looming that could happen. We believe it is highly, highly unlikely to happen. Why? When there are accidents, they are studied incredibly thoroughly and all of the protocols are shored up. So after Fukushima, the entire global nuclear fleet basically did a gut check, and most countries had newly implemented safety protocols that came in the wake of that accident. So the world's fleet is far, far safer now than it was before Fukushima. And that event we have to thank for that. Unlikely to happen, would be bearish if it did, but still it's there. Unexpected reactor closures. Now, this is less likely than you might think. So an unexpected closure is, at this point, I don't even know where that could come from besides the aforementioned accidents. So right now, electricity is getting more and more expensive, more and more precious globally. We do model for quite a few reactors to close globally in the next 10 years. That's part of that graphic supply and demand model that you saw. So it's not that every single reactor is going to be extended beyond its existing license. It's that an unexpected closure, we don't know where that could come from. So that seems highly, highly unlikely, but sure, a reactor closing that we didn't model in to be closed, that's bearish, could happen. Unforeseen supply surprises. Now, this one is also very, very unlikely because it's pretty known what's out there and being developed currently as far as mining projects, as far as supply surprises. I swear every month or two, somebody sends me a new article about China's seawater uranium extraction breakthrough. You guys, this is a decade away, if not longer, for actual commercial level utilization of this technology that is still in its infancy and still inefficient. So that is not going to disrupt this market in the next 5 years, period, full stop. What else could be a supply surprise? We don't see any major overhangs of inventory or secondary supply that could significantly come into the market. The big one, I suppose, would be the pounds held by the financial entities like Yellowcake or Sput. You know, Sput has 63, 64 million pounds in storage right now. And utilities, there's still some utilities that think that that material is going to be sold to them by Sput. It's not. They have a mandate to hold and store uranium to give you, as an investor, exposure to the commodity itself. That's their mandate, period. Is there a case in the future where they might have to sell 50,000 pounds in order to shore up their balance sheet? Sure. This was a concern a few months back. They, of course, did a private placement where multiple institutional entities, and they raised 25.5 million. They paid a premium to the market price in order to put that money directly into Sput's pocket rather than buying at a discount in the open market where Sput would not benefit from any of that cash. So that took away that concern for the near term, but it is possible in the future. Can a consortium of utilities come together and offer a takeout bid for Sput that would have to be a 2/3 yes vote by Sput's unit holders? That's also possible. Sput sitting here at a 4.4 billion AUM. They're going to come in with a 6 or 7 or 8 billion offering together in order to buy all that uranium, sufficient of a premium to where 2/3 of the unit holders will vote yes on that offer. This is something that we're not concerned about. This is something that, if that happens in the future, the dynamic in the physical market will be such that we will already be very, very pleased with the returns on our investment at that stage. So that's the only unforeseen surprise of supply that we can estimate. What's coming out of the ground now, what's under development and could come out of the ground in the next 5 to 10 years, it's largely known and it's in our model. Then we go to right tail. What are some possible shocks to the supply or demand that are right tail? Reactor life extensions. Like I said, we are modeling for no life extensions for Diablo Canyon, for any of the Spanish fleet. We're not modeling for the Taiwanese reactor to be turned on, even though they are already discussing that, despite the fact they shut it down 2 weeks ago. We're not modeling for German restarts, so reactor restarts. Greenfield supply delays. So in our model, we have reasonable timeframes for these large greenfield projects. And I've talked about the large ones. There's smaller ones as well. There's the mine number 6 in Russia that's been 24 months from production for the last 8 years. Santa Quitéria, which is a phosphate project in Brazil. There's another dozen that are greenfield. They're under development or will be in the next few years, assuming the price stays stable and rises for these lower cost projects. Delays in greenfield is our base case, but we don't model for it. So the model that you saw assumes reasonable timeframes to development of these projects. Further delays in any of the supply coming out of the ground is going to have a meaningful amount of upward pressure on the price because the deficit is such that the pounds that utilities can and will procure must literally come out of the ground. And this is the first time in the history of this industry, despite the very early 50s and 60s. Since then, this is the first time that that has been the case. So from 93 to 2013, we had 20 million pounds a year coming out of Russia going to the US utilities from downblending. That stopped, and that's not about to happen again. Stockpiles in Russia and the United States of HEU and decommissioned warheads are 10 or 15% of what they were in the 90s. So that's just not a potential source of uranium for the global industry. Will the US get some downblending going for potentially some HALEU support for the first projects? That's possible. But military stockpiles as supply for global utilities, not something on the table. Secondary supplies, inventory overhang, it just isn't there. And if you take anything away from this podcast today, that is what you should take away. There's no buffer for this industry right now. Yes, the utilities have been able to flex up on their contracts for the last 3 years. They've been able to buy a little bit of extra EUP from China or from Russia. I'm talking about the US and EU utilities. They've been able to secure conversion and enrichment for the next 3, 4, 5 years. Yet they have yet to purchase sufficient amounts of uranium to feed into those services. And that is what's coming in the near term. That's a near term driver. When we look out 2, 3, 4 years, when utilities really come in size to procure for the 2030s, that's when you know what's going to hit the fan because the supply isn't there. And what is going to happen is already going to happen. We don't need any catalysts any longer. To quote Mike Alkin from Sachem Cove, we don't look for catalysts, we look for conditions. And I'm telling you right now, the conditions are such that you don't have to know what's going to disrupt this market. You just have to know that the conditions are there, that something inevitably will. That's what we're going to let play out. What else could be a right tail driver? Accelerated SMR demand. You could see if we go back to our demand, the dark gray at the top is the SMR demand in our modeling. If that accelerates significantly, that's going to be something that most models are not including whatsoever. And this is very, very conservative. The SMR demand we have in this model is more conservative than Canaccord, more conservative than WNA, than most other entities that are doing this. Considerably conservative, knowing there already is demand in the market right now for SMRs, for uranium. Sovereign strategic uranium stockpiling. Okay, what countries currently are stockpiling uranium for sovereign strategic energy security? You can count them on one finger. China. If any other countries start doing this, that is demand that isn't here. Period. Full stop. Strategic stockpiling of uranium. Energy is a national security imperative. Will we see this? Well, we are conservative about it. We're not modeling for it. Any demand that is coming from sovereigns is right tail. And lastly, military demand. This is something that the Chinese have been stockpiling for. This is something that the US has not procured uranium for the military stockpiles in decades. And it's entirely possible that that happens. Of course, that's not in our model. We have communicated with multiple entities that are close to Washington that believe that in the next 4 or 5 years, we're going to see procurement on behalf of the US military. We don't model for it. It's very difficult to get that information accurately, but we do know that the inventories for the US military are on the lower side when it comes to uranium. So any military demand from any other country besides China, or China continues or even goes larger demand, that's possible too. That is all right tail, not in our model. So where are we at right now in the long-term contracting cycle? The top graphic is from Cameco's website where they print the monthly reported long-term contracted price, that it's a blend of UxC and TradeTech. So right now we're $80 a pound. The yellow shaded segments of that graphic are periods of relative stagnation. So since May of last year, we've basically been in a $2 trading range in the long-term contracted price. Maxed out at 81.50. That was largely influenced by TradeTech's number that was higher than UxC. That's where we've been for the last 12 months. Trading range of $2 a pound. The green segments are where we've seen periods of sustained larger price moves to the upside. Now we go back to 2023 and you look at the bottom graphic, we had 160, I think it was 162 million pounds procured in the long-term contracting market. A lot of that was from China. But going back to 2023, the Koreans came in with an RFP that actually didn't get filled. PG&E was buying in 2023 for Diablo Canyon extension. UxC claims that they get about 80-85% of demand. So maybe we got very, very close to replacement rates in 2023. What happened to the price in 2023? Well, started out at 52.50. By the end of the year, it went to 72. Okay, so that was January. The January print was 72, 68. Either way, we saw, what is that? A 20% move in the long-term uranium price by a single year in long-term contracting. And arguably that move continued. There was momentum from that contracting that continued into early 2024. So we did see some contract procured in the early part of last year. And this year it's been basically dead. 26 million pounds have been contracted in the long-term market. Year to date, annualize that, that's now, what is that? Less than 30% of replacement rate. If we look at actual demand, reactor demand this year is close to 200 million pounds, according to our model. That's new reactors hitting the grid that have a 3x fuel demand for that first core load, in addition to the operating fleet of the world and the burn up, close to 200 million pounds for this year. Right now, we've contracted 26 million pounds. So the industry always has a little bit of inventory, a little bit of flex. And that flex has been expressed in the last few years. 2023, decent year in contracting volume, and look what it did to the price. Prior to that, they had 11 months of relative stagnation. Prior to that, 10 months of a big move, 33.50 all the way to $50 a pound. Late 21, early 22. Now, late 21, we had the advent of spot in their ATM, buying a lot of uranium. Spot, in the spot market, we had carry traders unwind pounds into the spot market and then go in and procure more out into the future curve. That put pressure on the term market. They are connected. Spot and mid and long term are not necessarily totally separate markets. There's always trading that happens between them that kind of glue them together. So they tend to move in unison. The point of this graphic at the top is that there are 10 to 12 month periods of relative stagnation followed by 10 to 12 month periods of upside movement. Historically speaking, this is going back the last 4 years. So my question to you is, what happens next? Do we have another month at 80? That's entirely possible. How about another 2 months? Sure, totally possible. But the move that happens next is not going to be to the downside. And importantly, look at what has happened to the long-term price during this period of stagnation in the term market. So the term market has basically been stagnant for the last 8 months. What has happened to the price? Dead flat. Why? Producers are not offering lower prices. Very few entities, primarily one developing company, selling pounds at $80 fixed. Everybody else, the big producers of the world, the Kazatomprom, their joint venture partners, Cameco, Orano, BHP, they are all requiring higher price contracts. Cameco, for example, in the most recent conference call, they're saying, we are still demanding 75, 80 floors, 130 plus, $130 plus ceilings, market reference contracts, which means at the time of delivery, what the utility pays to the producer for that uranium is referenced to the spot market, whether that's a multi-month average or a blend between spot and term, depends on the contract. These things are bespoke. We don't have access to them. Nobody does. What happens next is the price moves up. Why? Because that's what the producers want. And I hate to tell the utilities this, but it's a seller's market. And they are holding on to hopes and dreams. The arrow is going to show up and solve everybody's problems. And I'm telling you that isn't the case. And there's going to be a rude awakening for utilities in the next few years. Like I already said, what is going to happen is already going to happen. Whether or not they know it, that is what is going to happen. The supply that is going to solve their procurement needs must literally come out of the ground. They're not going to buy it from a stockpile from XYZ country. It has to come out of the ground. When it has to come out of the ground for a project that isn't built yet, that's a problem. And utilities don't know it's a problem yet, but they will. And that is what's coming. This trend is going to continue, you guys. Maybe another month or two of this yellow, entirely possible. Hard to say. We do know there's some near-term demand coming into the term market. How big that demand is going to be remains to be seen, but it is there and it is going to come. And when it does, we're going to see the next wave to the upside in the long-term price. The previous moves have been 20 to 30% moves. We see a 20% move, we'll be at $95 to $100 term, which is what is needed for the low cost projects to be like, all right, we're going to do an FID. We'll get the ball rolling here. But again, you can see where the trend is going in the volume on the term in the term market 2024. Look at now. This year to date, it's half of that. It's a third of the bar from last year down here. And this slide is from Kazatomprom's investor handout. We have yet to see the quote unquote replacement rate term contracting cycle. It's going to happen. You're going to want to have a seat at the table. So what if the price doesn't rise? We've also modeled this out. So all of the low cost projects in this model still get built. That's Phoenix, that's DASA, that's Arrow, that's some of the US ISR gets built at these prices, but not very much. They certainly aren't going to ramp to 10 plus million pounds a year in the US at $72 spot 80 term. That's not happening. But the big projects in Namibia, not getting built. The marginal projects in various other countries, or the big underground projects that are decent medium to higher grades in the Athabasca, besides Arrow, those are probably not getting built at these prices either. These companies don't exist to break even. They exist to bring value to shareholders. That's what they're supposed to be doing anyways. They also, especially when we're talking about existing and legacy producers like Cameco and Orano, they went through absolute hell in the previous decade. Now the utilities are sitting around going, whenever we come into the market, it's always there for us. Well, they know that it's not now. And what they've done in the past couple of years, especially because of the disruption in Ukraine with Russia, Russia being the biggest provider of conversion and enrichment, utilities largely, to speak generally globally, have done what they can to procure those services in a disrupted market. Uranium will come next, and it has to. It's not theoretical, it's not hopeful, it's mathematical. You buy these services, you have to feed into them. You buy enrichment, you have to feed UF6. Well, guess what? There's no UF6. There's minimal conversion, and you likely already bought that conversion. This is why the market's so tight and the price is so high for spot and term conversion. It's coming down a little bit now, but still historically high pricing for those services. Uranium feed comes next. So what happens if the price doesn't rise? Well, all the low cost stuff still gets built. This still assumes Kazatomprom can ramp to 70 plus million pounds a year. This assumes most projects in Namibia do not get built. The US stays relatively stagnant out of maybe a few million pounds a year. This is what you get. So I only graph this out because I think it's very, very interesting to see, look at the world's projects, the potential greenfield projects, and just really go through and say, this is getting built, this is not. And this is where we are. So price has to rise. It has to rise. And that is my favorite type of investing setup, is when you know something must happen. It's not, oh, will OPEC ramp up, will OPEC cut. The oil market is so much more complicated. While the industry here that we model is incredibly nuanced with an enormous amount of difficult to decipher data, it's actually quite simple to see what is operating and what's going to be operating in terms of nuclear demand, and to look at the mines around the world. Currently operating brownfield, greenfield, potential greenfield mines, there's less than 100 globally, and you can name probably on two hands the primary producers that are currently producing into the market right now. It's a very, very small world. So this is a high confidence bet that we're making, looking at how de-risked the demand is and how problematic the supply is and will be. The setup that I'm seeing here is incredibly, incredibly de-risked. And it's sort of like we've gone through somewhat of a reset in this market, in this bull thesis. A lot of people that capitulated in the last 6 months probably believed that this trade was over. The spot price stayed stagnant for a long time. It continued to drip down on very low volumes and really aided when markets generally went risk off March, April, and the uranium price was dripping down by 25 cents a day or whatever it was. So many people threw in the towel. And I'm not blaming them, okay? It is what it is. There's always a market like this. Everyone will not always take the same side of a trade as you. Don't take it so personally. You're bullish and someone else is bearish, it makes a market, and that's totally fine. We saw an enormous amount of capitulation based on short-term data, which is the spot price dropping. It's not the right way to look at this. This has again become a contrarian bet, similar to how we saw back in the late 2010s, where we knew the price had to rise, not because demand was shooting up to the upside. The major projects were offline and idled. Cameco had MacArthur offline, $10 million a month in care and maintenance. For that to come back online, we had to see the price rise. So that was a Also, a relatively easy contrarian bet because we knew something must happen. Then the price responded. Some brownfield supply started to respond. Langer Heinrich came back online. Carther River came back online. Utilities bought some uranium. They bought some conversion enrichment. The price across all of the elements of the fuel cycle moved up and moved up significantly so in some of these runs. Sput came in and bought a bunch of uranium. The hedge funds came in and bought some uranium. We've had all of these drivers that have moved the market higher. And so there's a theory, okay, we hit replacement rate, supply is responding, and now it's over. That could not be further from the truth. Now we've had an equities reset. And if you actually chart, why don't we just do that? Let's just chart it right now. Starting off with URA as compared to the spot price of uranium, you can see that the equities following the peak of the move, the first initial leg of this bull market that we saw back in 2020 to 2021, following that, the equities have traded essentially down to sideways against the price of uranium. Over the past 10 weeks, we've seen a very, very large move for the sector. In fact, URA, as I'll show you in just a moment, the weekly chart of URA, 10 weeks in a row that were positive for URA, which is the longest up streak in the ETF's history. Yes, we've had big moves in the past where it was up 4, 5, 6, 7 weeks in a row. Never have we seen URA up 10 weeks in a row. Now, things are pretty overbought here in the short term, but either way, let's look at a couple of relative charts first, ratio charts, URA against the price of uranium itself. Finally, a nice move to the upside. In fact, we are trading well above that 200-week moving average on this ratio chart, something we haven't seen since February of 2022. So it's been almost 3.5 years since we've traded up and well above that 200-week moving average, which is trying to flatten out here. The 20-week and the 50-week are moving up in unison. Both will surpass the 200-week. Whether or not we go into a quieter period for the next couple of months in the summertime, certainly looking that way according to what is happening in the physical market or what is not happening in the physical market. But the equities continue to have somewhat of a bid here, despite the fact that physical uranium is a little bit quiet. Let's look now at straight URA and the weekly chart of URA. Now this is just has been absolutely on fire, trading at a decade plus high, 36.13 as of the close today. So we're at a high print since March of 2014. Incredible, incredible move over the past 10 weeks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks in a row of positive moves for each week. Truly incredible. And again, look at that weekly volume for URA. Record or just about record compared to March 22, similar weekly volume. Just about record volume for URA, right in line with the record volume for this ETF. Of its entire history, a lot of money is trading hands in this sector right now. We've seen a lot of new eyeballs and a lot of new money enter this trade in those last 10 weeks. And of course, leading up to that, we saw a lot of money bail out. A lot of money bail out during this period of time. Then we saw, what did we see? Major redemptions for URA. Now, at least that has ended. We haven't started to see even yet big inflows and big share issuance for the ETFs in the space. But for this period of time, February, March, April, into early June, we had huge redemptions for URA. So really, it was kind of this area here, this area here. And over both of those periods of time, all around this area, we've seen major redemptions. And a lot of that came through JP Morgan. Whether that was as a prime broker or money they were actually managing, it's hard to say. But what is easier to say is they certainly sold at the wrong time. So smart money isn't really always smart. Institutional money tends to be early when it comes to these trades or very, very late, not necessarily trend following. So there's still a lot of money on the sidelines just waiting for the spot price to really start to move here. This is a really beautiful looking chart. Still, this is weekly. The 20-week is below the 50-week. That's going to change shortly. The rising 200-week looks absolutely gorgeous. Let's look at the daily chart for URA. Very overbought still, and we're actually seeing daily RSI slowly decline as the stock price itself rises. That is negative divergence. Usually, that's a very reliable short-term signal, signaling a pullback is imminent. absolutely would make sense here to have RSI above, let's say 75 for the past 2 weeks and to continue to climb higher. So a higher price for the underlying equity and a lower high for the RSI. That is precisely negative divergence. This is not a long-term indicator. It is a short-term indicator that a move is imminent. And that's the opposite is the case with a bullish divergence. When you have lower lows in the actual equity price and higher lows or similar lows like this going back to last summer where we had similar like a double bottom pattern here. This was early August and early September. We had the washout early August that was the Japanese yen carry unwind, and then early September the sector puked out. Right before and during the WNA conference, of course, I was at the conference in London early September, and I sent out a members only video to our subscribers the last day of the conference and basically said, you guys, big stuff is coming. The sector is wrong. Buy that ignorance. And of course, that was a major, major signal for that moment in time. Right here, that bottom, that red candle that bottomed September 6th, that was the last day of the conference. Then what did we see? A 2 month move of about, what is that, 50, yeah, almost 50% over the next couple of months following that conference. So similar signals back here, April, early April. What did we see? We saw the physical market in the spot market where we had seen motivated selling all the way back here in December. So leading into December, the spot price was falling, the equities were falling. We saw some profit taking from the move that happened September through November. And we saw some hedge funds and some other traders de-risking and dumping some pounds into the physical market. We also had this overhanging sale or potential sale of a couple £1 million from the failed ANU fund in Kazakhstan. That was putting some downward pressure on the market. So the spot price was falling. Motivated selling continued. We saw the big deep seek move down. That was later in the month. That was here, but some chopping from December through early February. So the big deep sea scare was this here Monday, the 27th. That was a very large down move. But what I'm saying here is from about here to about, let's say, here was some low volume but persistent selling pressure in the spot market. We were watching this continuously. And as the spot price fell, we started to see something turn. So the spot price bottomed back here in March into early April, but started back in March, where we had a low enough price where the carry trade started to get done. So the midterm price that could be sold by traders was significantly higher than the spot price, and the traders were able to go in, buy in spot, deliver into the midterm, calculate interest rates, the cost of carry, the cost of capital, and make a little bit of a profit on that. That's the carry trade, and it happens when the market dynamics can support it. So selling pressure all throughout this period was selling pressure in the spot market. It wasn't huge, but it was enough to keep the spot price from moving up and actually continued the move down. Then that dynamic ended right about here, and we noted that. So what happened? We saw another move to the downside in equities. So still charting URA here. We saw another 20, almost 25% move down in a couple of weeks, late March, early April. And much of that was correlated to broad market weakness as well. So we saw the markets influencing the price of the uranium equities down, yet we saw a shift in the dynamic in the physical market. That shift said, the selling pressure has subsided. The utilities are in the spot market. The utilities are buying carry trades. And this dynamic is likely to shift the price of the market. So what did we see? The price bottomed and started to move in the opposite direction, even as the equities continued to sell off. So what does that mean? When the physical market is doing something different and the stocks are at RSI freaking 23, and some of the individual equities were at RSI 20, 19, 18, just extremely, extremely low relative strength, usually is a signal that it's time to put money to work and potentially aggressively. That, of course, was signaled to our membership that this washout low was happening largely influenced by other markets and after the dynamic in the physical market had shifted to positive. So now we've seen a recovery in the spot price of about $6 or $7. It's right here at 69.75, something like that. It was up a little bit today as I record this. Spot looks like they raised some cash today as well. So that dynamic has shifted. Still not a lot of excitement in the physical market, still very, very quiet right now. But What I'm trying to highlight is that you have to follow the physical market, and we do on a daily basis. So we express to our paid membership the market has changed, dynamics have changed, and the equities are getting thrown out like the baby with the bathwater. It's time to put money to work. And we did that. And of course, we've seen a historic move for URA and for most of the sector. Now, URA, of course, has been lifted by the non-uranium names and some of the nuclear names. Cameco is the largest holding. Cameco's been on a moonshot. Then we have the small modular reactor equities that have moved up very robustly as well, and some of the picks and shovels that are held by URA. Not exactly uranium equities. The uranium equities themselves have been lagging a bit because uranium itself hasn't moved in a super robust way. We've made a decent little reversal off the bottom, but things could get quiet here for a minute. Either way, the uranium equities are the contrarian bet here because the nuclear story is so good and continues to grow. All right, I've already mentioned a lot of this, but I wanted to mention that again with the backdrop of the charts. So, what are we seeing right now with the charts here? URA overbought, negative divergence, likely to see a pullback. Now, that pullback could come all the way back down here. 28.90 would be a perfect gap fill. If it traded down to that level, that would not be surprising whatsoever, and actually would be very, very technically constructive for that to meet up probably with a rising 200-day, and the 50-day is going to come through that. So this could come down, chop around, come down a little bit more. We could find support at that gap fill and that rising 200-day. And that could take a week or two or a month or two with some backing and filling, some chop. Entirely possible. The spot price has been basically stagnant and quiet for a couple of weeks here, but we continue to see the sector catch a bid. Largely has been headline driven, but again, today, nice moves across the sector. Overall, no real big headlines. In fact, the headlines you could argue were slightly negative with the attacks in Iran on their nuclear facilities. There wasn't any radioactive event. They weren't bombing the actual nuclear reactors, but the enrichment facilities, mildly radioactive. You could say that in other instances, the market could have reacted significantly more negatively to news flow like that. Either way, probably time for some backing and filling in the summertime. And I've already mentioned this, I'll mention it again. Whatever pullback we have this summer, you're going to want to buy that dip. Why? Because we've had, with very few exceptions over the past year plus, a relatively stagnant market in spot and term. We've had some decent volumes traded in spot February, March into April. Some carry trades got done, a lot of utility involvement, but the term market is still dead quiet. 26 million pounds have been procured there. This year to date, that's about like 28% if you annualize that of actual demand, 28% of replacement rate. That's how slow it's been this year. Could it stay slow for another month or two? Absolutely, it could. And it probably will. We're going into the summer doldrums, right? That doesn't mean that something couldn't come across the tape that drive these things higher or cause the sector to move. I am not expecting a big pullback with all of this or even most of this move reversing. We're going to see some support here. There's new interest and the sector is clearly behaving differently. There's a bid here. Doesn't mean it's going to keep going higher in a straight line. It probably won't after 10 weeks in a row of positive movement for URA. Some digesting is always necessary after big moves, and that's not unique to uranium. That's just investing. Let's look at Cameco. Another huge, huge move. So we saw this bull pennant come out a couple weeks back with a big gap to fill. So that was a little bit of kind of divergent views technically. Bull pennants are usually resulting in moves higher. In this case, that was absolutely the case. But big gap here that could get filled and yet another gap. Now, I would argue this latest gap that happened earlier this week, likely that gets filled. We're going to need this move to be digested. And if things get quiet on the nuclear front, along with a quiet spot price, then we're going to see essentially some pulling back in the sector, which would be perfectly technically healthy. Either way, this stock move has been a monster for Cameco, an absolute monstrous move. And you saw the news, I'm sure, earlier this week to begin the week. Actually, I think it was over the weekend, prior weekend, that Westinghouse is proposing essentially to meet the dictates of the executive orders to have 10 large reactors under construction in the US by 2030. And so, still, we're waiting to see what the support will be for the nuclear reactors in the US. But the article that came out, the Financial Times article, saying Westinghouse with a 72 or 75 billion off the top of my head proposal to build 10 large AP1000s in the US, that's, less than 8 billion per reactor, which is even cheaper than unit 4 of Vogtle. Unit 3 of Vogtle was almost 20 billion. So unit 4 came in right around 10 billion. If we build 10 of these things, those costs are going to drop even further. So fantastic to see Westinghouse stepping up, within a couple of weeks of the executive order saying, here's our proposal. We think we can do this. And that's absolutely fantastic. There were also hints in that article that there will be tax incentives and billions and billions of dollars of incentives of various forms to get this done. So very good to see. We're still waiting for the Senate bill to see what exactly in terms of dollar amounts will be included there in the budget, but looking positive. And of course, Cameco is a 49% owner of Westinghouse, and estimated attributions to EBITDA from the Westinghouse ownership are starting to come out. This is going to be a monster outcome to the acquisition of the minority ownership of Westinghouse. And you go back and see what the stock did when they announced that. Of course, right back here, the stock tanked based on that equity raise that they did to aid in that acquisition. Tanked all the way down to 21 bucks. Now we're sitting here, the stock has tripled. And this is going to be a huge, huge winner. Now that Cameco is not just a uranium miner, not just a converter, they have exposure to enrichment through global laser enrichment, more conversion potentially through Westinghouse's Springfields in the UK. They have fuel fabrication from Westinghouse. And of course, they have the picks and shovel element of Westinghouse, the reactor parts, and the actual construction of reactors. So it's a soup to nuts, one-stop shop if you want to play the nuclear and uranium themes. Brilliant moves the company has made over the past years in terms of Westinghouse and establishing themselves just ahead of the real momentum for the quote unquote nuclear renaissance. URA against the S&P 500. Big, big gap to fill on a relative basis. So we could see the S&P outperform. We could see the uranium stocks pull back and the S&P stay flat. However, whatever happens, not every gap gets filled, but that's a chunky one, and it's highly likely that it does. Let's look at a weekly chart and zoom out a little bit here. Where's the trend here, you guys? Are we early or are we late to this story to see URA, or that is to say uranium and some nuclear names together, outperforming the broad market? We saw a very, very nice relative move coming off of the COVID lows, going to the first kind of blow off top November of 2021, 120% outperformance. That's a big move because the S&P likely also at the same time made a big move up coming off the COVID lows as well. So huge move for the sector. On a relative basis, it was big. On an absolute basis, it was even larger. We're going to see the resistance line here that I have, the big purple horizontal line. When we see a break through this, that's when we're really going to see the sector take off. And I would argue that these big, big moves for the sector have yet to happen. This is a very stretched out story. The replacement rate contracting or the contracting cycle hasn't happened yet. That is yet to happen. I already discussed this in the slide share, but you can see it in the charts. Where is the drastic outperformance of a real bull market compared to the S&P? We're not there yet, and that is yet to happen, and it's going to happen. Spot, of course, actually nice to see it catch a little bit of a bid this week, even though the spot price is down this week. And again, today, they were raising today, average daily volume, so they probably didn't raise that much, and they weren't at a huge premium or a premium for a bulk of the day, but they probably did issue trust units through their ATM, raise a little bit of cash. We haven't seen the numbers come in yet. We'll see it over the weekend. This has generally underperformed the sector. Why? Because the spot price hasn't moved as much as most of the equities in the space. And that will come. This is likely a good risk reward proposition, even though we're basically at NAV right here. And the spot price could back and fill a little bit here. But as soon as we get down another dollar or even two, if we do in the spot price, carry trade kicks back in. So we're not going to see this pull all the way back to 63, most likely, even if things get very quiet during the summertime. Well, we could see it pull back a little bit, but we know that there's significant enough utility interest in shoring up near and midterm needs through carry trades. So that will should and will get done if we see the price pull back. That could happen. Either way, the downside here is minimal for spot. The upside is very, very large. And this next move is going to take us likely past the previous highs of 104, 106. Going to take us up into the 1 teens, 120s, possibly higher, depending on how it goes. Once that trend is firmly established and in place, that is to say, we move through 75 and then 80, we're going to see the players come back in spot and term markets. We're going to see the volumes increase in both markets, and we're going to see the price continue to move up. Momentum moves in the physical market as well. So we started to see a lot more volume traded spot and term during this move here. And then that term and spot volumes decline during this move here. It's just how it goes. The trend is when it's on your side, it's really on your side in the physical market. And when the trend has been down, utilities step out. When the trend is up, utilities step in. That's just how they act. There's no incentive for a fuel buyer to catch a falling knife. You step back, you pull back demand collectively, see where it settles out. This is where it settled out. A couple months back, the low print here going back into early April, right? That was the low print, but we already started to see volumes come in with carry trades start to pick up, leading to that pullback. And it's interesting to see that pullback did perfectly align with the lows in the equities. So the equities were trading with spot, but they were also trading with the weakness in the broad market. All of this is to say, spot generally is heading higher. From today, hard to say, but overall, we're going to see another large move to the upside for the spot price of uranium. And if we zoom out on this, let's go out a week a little bit here. For spot, we're going to see this move up significantly. So we could see it back and fill, make a higher low. Let's look here finally at the actual spot price of uranium. I don't really like to chart this very much and look for technical signals here because nobody really trades this off of a chart. It's such an illiquid market. Utilities and traders buy when they need to buy. Traders sell when they need to sell. They're not going, oh, this looks like the RSI is X or the trend line is Y. This is time to buy or sell. Nobody does that in this industry. But I do find it absolutely uncanny that the pullback from last year to April perfectly aligned with the resistance point in 2022. Just absolutely uncanny, and actually just about pulled back to that rising 200 week. So zooming out on this, what we're going to end up seeing most likely in our estimation is going to be a continued series of higher highs and higher lows. So whether or not this pulls back a little bit and starts the recovery high into Q3, Q4, that's entirely possible. We might move up a little bit more. We might move up a little bit more. We're going to see this top out somewhere in this range, a little bit higher. And then we're probably going to see pulling back to a higher low. Whatever that ends up being, 80, 90, I don't know. Hard to say. Consolidation. Then we're going to move up again, higher high, higher low. And we're going to continue to see this until we reach a point where there is actually a panic in the physical market. And we believe that will happen, where we will end up seeing multiple entities essentially fighting over a limited amount of supply. And right now, if we actually were to see 20, 30, 40, 50 million pounds of demand come into the long-term market through various utilities trying to sign late decade 2030s, we're going to see a $5 to $10 jump easily in the term price. And of course, it'll happen the same in the spot price because the traders are that connective tissue between those markets. Midterm, long-term prices go up, they pull the spot price up via carry trade interest. It's always how it's going to work. So not much volume is needed to move this market, and that volume is going to come. Okay, we have an enormous amount of uncovered demand going out into the future. In fact, there is more than 400 million pounds of uncovered demand between now and 2035. 400 million pounds uncovered. And the majority of utilities are uncovered starting in about 2031. And I'm telling you right now, according to our modeling and most others industry contacts modeling, you get into that early 2030s, you start to see project after project in Kazakhstan declining to eventual not producing at all. We're going to see Rossing coming off in the 2030s. We're going to see Husab coming off in the later 2030s. We're going to see Langer Heinrich coming off in the 2030s. We're going to see Cigar Lake coming off in late 2020s. Yes, Cigar Lake not going to be producing by the early 2030s. That'll be gone. A lot of established projects will be done producing just at this time where a couple of large development projects that haven't put a shovel in the ground yet are going to be absolutely necessary to fulfill some demand there. And they won't be able to do it, not because they are likely to be delayed, but simply because the demand is going to outstrip supply, even if they get developed on time, which they won't. So we have a major pinch point coming in the early 2030s, and the utilities are whistling past the graveyard on this right now. That demand will come in. When it does, we're going to see very large moves in the spot price of uranium. We're likely to see north of $150 a pound before 2029 because the demand for the period where supply is vastly insufficient is going to come in the next 2 or 3 years. It's not going to come 2 or 3 years before that deficit. It's going to come sooner than that. And of course, now we're seeing the announcements potentially of large new builds in the US. The SMR demand is going through the roof. We're seeing de-risking via life extensions almost entirely across the board with very few exceptions. The demand story is getting better almost by the day. We're going to see big moves in the term market, and that's going to drive the price substantially higher. And those moves are coming. So this is why I'm saying if the market is quiet for a month or two from going forward from right now, take advantage of that because this is what's coming. This is what's coming, you guys. You want to be at the table for that. Okay, guys, that was kind of a long episode. I'm going to leave that there. There's so much more to discuss to this thesis. Again, my commitment to you is to do these episodes more often. I apologize. I haven't been on here since October. That's insane. So much has happened. So much is going to happen. The setup here is brilliant. It's become a contrarian bet again, and a bet on the uranium miners is a bet on a higher uranium price, where the valuations for these equities, instead of pricing in 70 or 80 bucks a pound, you're pricing in 100, 120, 150. Who knows where this goes? It's going to go as high as it needs to go. It's probably going to go higher even than that because the necessary incentive price is just to get the ball rolling on supply. It's not like the price gets to 100 and all of a sudden there's pounds coming out of Namibia that weren't there last year. That's not how it works. We've got to get to a higher price and then final investment decision, and then years of and hundreds of millions, if not billions of capex, and then cake in a can 4, 5, 6, 7 years later. That's how slow this industry is in responding to incentive pricing. To repeat, what is going to happen is already going to happen. Supply shortfalls, delays in greenfield development is the rule, not the exception in this industry. That's to speak for mining in general, but for uranium mining specifically, even the lowest hanging fruit ramping up in Kazakhstan, ISR mines, much faster to build, established insane production levels in Kazakhstan, and they're having a hard time. So this isn't easy, and supply is literally just not going to come bubbling out of the ground. It has to be incentivized, not only by price, but also by utility demand. So maybe we'll squeak by a couple more months, 80 bucks a pound, tepid demand. When the demand comes in, the price is going to move. When demand is not there and the price is flat and rising, that's a tell. That's your tell to what comes next. So take advantage of opportunities that the market gives you when you have conviction in the mid to long term for the trajectory of price and therefore the equities. Thank you so much. Really appreciate you being here. Really appreciate the support. Let me know in the comments below what you thought of this video. If you would like to see more of these podcasts, and again, click the link in the description. You'll get our full Case for Uranium PDF report that will dive into a lot of what I discussed today. Be well, take care, and I will see you in the next episode. Cheers.